Your spreadsheet says you are done. The IRS may disagree. You have hit your magical number. The popular retirement calculators online give you a big green check mark and tell you to pack your bags. But there is a massive blind spot in conventional retirement planning, a mathematical trap that treats every dollar in your portfolio as if it belongs entirely to you. It does not. I have run these numbers hundreds of times, and the reality is that gross net worth does not equal retirement solvency. When society shifted from pensions to 401ks, we all understood that investment risk was transferred to us. If the market tanks, that is our problem. But very few people realize that tax rate risk was also transferred. Conventional wisdom tells you to max out your pre-tax accounts and assume you will be in a lower tax bracket when you retire. That sounds logical until you realize you are conflating earned income dropping to zero with taxable income dropping to zero. In fact, forced withdrawals, Social Security, and passive income often synthetically replicate your working year's tax bracket exactly when all your best deductions disappear. Today, we are going to tear down the heuristic that a gross portfolio value is enough. We will look at the brutal math of the Social Security tax torpedo and how optimizing your withdrawal sequence can save you hundreds of thousands of dollars. Before we look at the spreadsheets, I want to invite you to subscribe to the channel. Now, let us talk about how we got here. This obsession with a single gross number is a hangover from the pension era. Back then, a pension provided a fixed, predictable gross income stream, and the tax withholding was handled quietly by the issuer. When the 401k became the default, the financial industry sold us on the beauty of compound interest, while conveniently downplaying the compounding tax liability. People see $2 million on their brokerage statement, and they feel a deep sense of psychological safety. Adjusting that number down by a 25% embedded tax liability induces immediate cognitive dissonance. So our brains just ignore it to preserve the dopamine hit. Online calculators perpetuate this illusion. They apply a generic, static 15% effective tax rate across the board, equating a $1 withdrawal with $1 of actual spending power at the grocery store. This is the money illusion in its purest form. We value nominal numbers over actual purchasing power. But the IRS does not care about the nominal high score on your Fidelity dashboard. They only care about what clears the bank. To understand the trap, we have to recognize that your pre-tax retirement accounts are a joint venture where the IRS holds unpriced equity warrants. You put up all the capital, you take 100% of the market risk for decades, and the IRS acts as a silent vulture capitalist. They contribute absolutely nothing to the enterprise, but they retain the legal right to decide their equity share, which is your tax rate, on the exact day you decide to cash out. By keeping 100% of your wealth in pre-tax accounts, you assume all the sequence of returns risk while granting the government a call option on your life savings. You put in the hard work, but you give away the ultimate pricing power to an entity that has completely different financial motivations than you do. You are optimizing your spreadsheet using today's tax code, and that is a massive game theory failure. You are playing a 40-year game against an opponent who has the unilateral power to change the rules at any time. Given the massive national debt, assuming tax rates will stay near historical lows is a very bold wager. The Tax Cuts and Jobs Act is currently set to expire at the end of 2025. If Congress does nothing, tax brackets will compress, marginal rates will jump, and standard deductions will essentially be cut in half. That means your lower tax bracket in retirement might mathematically vanish overnight, leaving you holding a massive bag of deferred tax liability exactly when you need the cash flow the most. It is the iceberg you do not see that sinks the ship. You have to account for legislative risk if you want to protect your wealth. If you think the standard tax brackets are tricky, wait until you hit the Social Security tax torpedo. Most people stop here, run standard math, and lose tens of thousands. Here is the step they miss. Imagine a married couple retiring in 2026. Their goal is to spend $100,000 a year net after taxes. They expect $40,000 a year combined from Social Security. Now let us meet retiree A, the conventional pre-tax retiree. They have $2 million saved, entirely in a traditional 401k and IRA. To get their $100,000 net, they cannot just withdraw $60,000 from their IRA and add it to their $40,000 in Social Security. They have to gross up their withdrawal to pay the taxes. But the IRS uses a special formula called provisional income to determine how much of your Social Security is taxable. Provisional income equals your modified adjusted gross income plus 50% of your Social Security benefit. So, retiree A withdraws roughly $78,000 from their IRA. We add that to $20,000, which is half their Social Security. Their provisional income is now $98,000. Because that is far above the $44,000 threshold, 85% of their Social Security is now subject to ordinary income tax. Let us break down the exact damage for retiree A. Because of the provisional income trap, $34,000 of their Social Security is now taxable. That brings their total taxable income to $112,000. Their standard deduction drops to roughly $16,000. That leaves them with $96,000 in taxable income. They will owe roughly $14,000 in federal tax plus state taxes. Their total tax bill is nearly $20,000 for the year. To get their $100,000 of spending money, they grossed $118,000. That means they are pulling at a true withdrawal rate of 3.9% from their portfolio. Keep in mind, this is just year one. As inflation pushes their living expenses up, their IRA withdrawals will increase, pushing their provisional income even higher. The Social Security tax thresholds were set back in 1993, and they are not adjusted for inflation. A threshold that only captured wealthy retirees 30 years ago now easily ensnares the middle class. Retiree A is caught in a compounding tax spiral simply because they used the wrong account. Now let us look at the optimized approach. Meet retiree B. They also have a $2 million portfolio, but they practiced tax diversification. They have $1 million in a traditional IRA, $500,000 in a Roth IRA, and $500,000 in a taxable brokerage account. Retiree B needs the exact same $100,000 to live on, but they use a strategic withdrawal sequence. They pull $25,000 from the traditional IRA, $15,000 from the Roth, and $20,000 from the brokerage. For the brokerage, we assume $10,000 is cost basis and $10,000 is long-term capital gains. Let us run retiree B through the tax torpedo. Their provisional income includes the $25,000 from the IRA, the $10,000 in capital gains, and $20,000 from half their Social Security. The Roth withdrawal and the brokerage cost basis are mathematically invisible to the IRS. Their provisional income is just $55,000. Only a tiny fraction of their Social Security is taxable. After the standard deduction, their taxable ordinary income is just $13,500. That $10,000 capital gain falls entirely into the 0% tax bracket. Their total tax bill is barely over $3,000. The contrast is staggering. Retiree A requires nearly $15,000 more in gross capital liquidation annually simply to fund the exact same lifestyle as retiree B. Retiree A has to bleed their portfolio at a much faster rate to feed the IRS. Over a 25-year retirement, compounded at a modest 6% opportunity cost, retiree A loses over $820,000 in terminal net worth due solely to tax drag. That is nearly half their starting portfolio value gone, completely unforced. And it gets worse. At age 73, required minimum distributions hit retiree A like a freight train. Based on a $2 million balance, the IRS will force them to distribute over $80,000 a year, pushing them blindly into higher marginal brackets. Retiree B does not have this problem. Because they drew down their traditional IRA early, their future RMDs will be small and manageable. They control their taxable income. This is the difference between letting the tax code happen to you and happening to the tax code. If you do not actively manage your withdrawal sequence, the default rules will quietly drain your wealth before you ever get to spend it. We will get to the exact portfolio allocation in a minute, but first, we need to talk about a hidden leak. This is where conventional wisdom tells you to keep saving, but I am going to tell you to rethink your entire structure. Most people realize the tax torpedo is real, they get overwhelmed, and they do nothing. That paralysis is the opportunity cost trap. They think leaving the money in the traditional IRA is the safe, default choice. But in a system built on legislative risk, the default choice is engineered to extract maximum revenue for the state. You are operating as if the tax brackets of today are written in stone. They are temporary policy choices written in pencil. When you keep 100% of your assets in pre-tax accounts, you are betting that the government will require less of your money tomorrow than they do today. That is a wildly speculative position. The only way to hedge against this risk is to build tax optionality into your portfolio right now. You need to transition from focusing purely on asset allocation, which is what you hold, to asset location, which is where you hold it. Building this kind of tax optionality requires precision. You cannot wing it. You need to know exactly what your baseline expenses are, and you need a system to map out your cash flow across these different accounts. That is exactly why I built CashClass, the official Tom Talks Money web app. CashClass is entirely privacy first. There are no bank logins required. You just upload your CSV statements and you retain total control over your data. It gives you a clean, distraction-free environment to categorize your spending, project your cash flow, and build a mathematically rigorous plan. Plus, when you sign up, you get access to my free Budgeting 101 course built right into the platform. It is the operating system for the optimizer. So if you are ready to stop guessing and start running the numbers like a professional, click the link at the very top of the description to start your 14-day free trial on the web. It is the first step to taking your financial architecture seriously without compromising your privacy. This brings us to the psychological hurdle keeping smart people paralyzed. It is called omission bias. It tricks us into thinking that doing nothing is inherently less risky than taking an action. We perceive an upfront tax payment, like doing a strategic Roth conversion today, as a direct loss. We hate writing that check. Meanwhile, we completely ignore the geometric compounding of the tax liability sitting inside the traditional IRA. We suffer from hyperbolic discounting, preferring the immediate payoff of a current year tax deduction over the much larger future reward of tax-free distributions. It is human nature to kick the can down the road. But in tax planning, kicking the can is incredibly expensive. You might save a few $1,000s in taxes in your 40s, only to set a trap for your future self in your 70s. Every dollar that grows tax-deferred is a dollar that will eventually be taxed at ordinary income rates. And because the IRS knows human nature, they built in that forcing mechanism. At age 73, they force you to pull money out and pay taxes whether you need the cash or not. Let us look at a mechanical analogy for your wealth. Think of your gross income during your working years as a raw, unfiltered water source. The accounts you use to save for retirement are different types of filtration buckets. Your taxable brokerage account is like a coarse filter. It catches some debris, meaning there is some tax drag on dividends and capital gains, but the water is highly accessible and liquid. Your pre-tax traditional 401k is essentially a giant holding tank. It feels great to pump water in there because it lowers your current tax bill, but that tank gets increasingly pressurized as it fills up. The government controls the release valve, and when you hit your mid-70s, they turn it on whether you are ready or not. That is your required minimum distribution. If you only have a pressurized holding tank, it will eventually burst, spilling a massive portion of your wealth into the government's drain. Your Roth accounts, on the other hand, are like pure, bottled water. You paid a little bit to filter it up front, but now it is clean, sealed, and immune to whatever contamination happens in the tax code tomorrow. This brings us to phase 1 of the optimizer's protocol. Never fund a retirement without creating tax optionality. Your portfolio must have 3 distinct tax treatments. First is your tax-deferred bucket, your traditional 401ks and IRAs. These are perfect for filling up the lowest tax brackets in retirement. Second is your tax-free bucket, your Roth IRAs, Roth 401ks, and health savings accounts. This money is immune to legislative tax hikes, and most importantly, it does not trigger the Social Security tax torpedo. Third is your taxable bucket, your standard brokerage accounts. This bucket allows for long-term capital gains, which currently have a 0% tax bracket if your income is low enough. It also allows for tax loss harvesting. If you hit retirement age and all of your money is in bucket 1, you have failed the preparation phase. The goal of the accumulation phase is not just to hit $2 million. The goal is to hit $2 million distributed cleanly across these 3 buckets, so you hold all the leverage. By holding all 3, you dictate exactly how much visible income you report to the IRS in any given year. This is where conventional wisdom says to max out your savings and wait until retirement. I'm going to tell you to stop and willingly pay taxes today. Here is why. There is a golden era in your financial life called the retirement tax window. This is the period between when you stop earning a W-2 paycheck and when your required minimum distributions and Social Security begin. For most people, this window opens around age 60 and closes precisely at age 70. During this decade, your earned income drops to 0, which means your marginal tax bracket plummets. This is your opportunity to execute systematic Roth conversions. The protocol is simple but requires discipline. You run a marginal tax analysis. If you drop from a 32% working bracket down to a 12% retirement bracket, you systematically convert funds from your traditional IRA into your Roth IRA up to the top limit of that 12% bracket. You intentionally generate taxable income on paper. You are willingly paying 12 cents on the dollar right now to permanently eliminate a forced 24% or higher rate later when your RMDs and Social Security stack on top of each other. Once you reach the withdrawal phase, you execute the tax alpha withdrawal matrix. You do not just pull randomly from whatever account has the most cash. You draw in a precise order to minimize your provisional income. Step 1 is calculating your Social Security torpedo threshold. You determine the exact dollar amount of income you can take before your provisional income crosses the threshold. Step 2, you draw from your pre-tax traditional accounts only up to the top of your standard deduction and the absolute lowest marginal bracket, the 0 and 10% effective tax zones. Step 3, you draw from your taxable brokerage account utilizing the 0% long-term capital gains bracket. Married couples can realize over $94,000 in long-term gains without paying a single dime in federal income tax, assuming they have no other income. You sell specific tax lots with a high cost basis to generate cash flow without generating taxable income. Finally, step 4. You fill the remaining gap in your lifestyle with Roth distributions. Because Roth money is mathematically invisible to the IRS, it allows you to maintain a high standard of living without pushing yourself into higher tax brackets. The most critical reason to rely on that invisible Roth money in later years is to avoid the final trap: IRMAA. The income-related monthly adjustment amount is a hidden tax on your Medicare Part B and Part D premiums. Unlike normal tax brackets, which are marginal, IRMAA operates on a cliff system. If your modified adjusted gross income goes even one single dollar over the threshold, you are hit with a full-year premium surcharge. A $1 mistake can cost you thousands of dollars in excess healthcare premiums. Required minimum distributions from traditional IRAs are the #1 cause of accidental IRMAA triggers. Retirees hit their mid-70s, the IRS forces them to take an $80,000 distribution, and suddenly their Medicare premiums double. It is an incredibly frustrating wealth leak because it is entirely predictable. By utilizing the tax alpha withdrawal matrix, draining the pre-tax accounts during the tax window and leaning heavily on Roth and taxable brokerage accounts later in life, you control your magi. You steer clear of the IRMAA cliffs, you keep your Social Security largely tax-free, and you preserve the net purchasing power of your entire portfolio. When you step back and look at the whole picture, you realize that your retirement portfolio is essentially an iceberg. The part above the water is your gross net worth. That is the nominal number you see on your spreadsheet. It is the number you brag about at the country club. But the part below the water, the embedded tax liabilities, the IRMAA surcharges, the Social Security phase-outs, that is the block of ice that actually sinks the ship. A $3 million portfolio that is entirely pre-tax is mathematically inferior to a $2 million tax-diversified portfolio. The optimizer understands that the only metric that matters is terminal net cash flow. If you found value in breaking down this math today, I want to invite you to join our inner circle by clicking the Join button below the video to become a channel member. We call it the Optimizers. It is a way to directly support the channel, but more importantly, you get priority replies to your comments and you get those custom sketch badges next to your name. It lets me know exactly who the dedicated analytical thinkers are in the community. Retirement planning is not about hitting a static number on a generic internet calculator. It is about actively mitigating risks, and tax risk is the most ignored variable in the entire equation. The IRS is a business partner that you did not choose, but you can absolutely manage their equity stake in your life if you put the systems in place early enough. Build your 3 buckets, respect the Social Security torpedo, and start doing the hard math on your net cash flow. The tax drag is real, but it is not inevitable. It only punishes those who refuse to plan. I want to hear your thoughts on this strategy. Drop into the comments and let us do some peer review. Are you currently executing Roth conversions, or are you still relying heavily on pre-tax accounts? Let me know where your data points lead you. Thank you for watching, keep optimizing your systems, and I will see you in the next one.